Let me ask you something honestly. If you make rupees 10,000 profit from sale of shares or stocks and even mutual funds, will you report it in your ITR? Be honest. Most people would say, छोड़ो इतना छोटा amount है क्या ही हो जाएगा. But this exact thinking is one of the biggest reasons people get income tax notices. Because today the income tax department already knows almost all your transactions from Zerodha, Grow, mutual funds and other websites, even from crypto platforms. Everything is already reported. But the real question is, are you reporting it correctly in your ITR? So in this video, I will show you 6 capital gain mistakes that can actually trigger a tax notice. And I will explain everything in super simple language so there's no confusion. Hello everyone, I am Suraj Deo and welcome back to the channel. Okay, let's start. First, very quick basics. What is capital gain? Capital gain simply means profit from selling an asset. And asset can be stocks or shares, mutual funds, gold, property, even crypto. So basically anything you invest in. So if you buy at rupees 500 and sell at rupees 700, then rupees 200 is your capital gain. Simple, right? But here's where people go wrong. Tax doesn't depend only on profit. It depends on holding period, asset type, and how you report it in your ITR. And this is exactly where most people go wrong. So let us discuss these mistakes one by one. Mistake 1. Not reporting small gains. Let me ask you again. Have you ever skipped reporting small gains? Most people have. But here's the truth. There is no minimum limit for reporting capital gains. Even if profit is rupees 1000 and tax is 0, you still have to report it. You know why? Because it already appears in AIS. If your ITR doesn't match AIS, system flags it automatically. आप ignore कर सकते हो, system नहीं. So would you risk a notice for hiding this small profit of just rupees 1000? Mistake number 2. Not understanding STCG versus LTCG. Okay, one quick question. Do you know how your stock profit is taxed? Here's the simple rule. For listed shares and equity mutual funds, less than 12 months means STCG. More than 12 months means LTCG. And tax rate would be for STCG 20% and for LTCG 12.5% without indexation. And obviously STCG means short-term capital gains and LTCG means long-term capital gains. For other assets like property, gold, etc., holding period can be 24 months and LTCG can be 20% with indexation. Now the most misunderstood point. LTCG up to rupees 1.25 lakhs in a year is exempt. That is tax free. Yes, tax free. But still it needs to be reported in ITR, and that's what most people forget to report. Mistake 3. Not disclosing foreign assets. This one thing most people don't even know. If you hold foreign stocks or any foreign assets, you must disclose them in Schedule FA, even if you didn't sell them or in case of no profit. Non-disclosure can attract penalties under the Black Money Act. So ask yourself, do you hold US stocks or international funds, and are you reporting it correctly in your ITR? One quick request. If you're learning something new from this video, please like and subscribe. It helps the channel reach more people. Mistake 4. Ignoring AIS versus broker data mismatch. People download broker P&L like from Zerodha, Grow, etc. and directly copy paste the details in their ITR. Sounds logical, right? But here's the problem. AIS and your broker report may not match. You know why? Because of different calculation methods like FIFO, etc. or because of any bonus or split adjustment or because of any timing differences. And when your ITR doesn't match AIS, system flags it. This is one of the most common triggers for automated notices. So ask yourself, have you ever checked your AIS before filing ITR? Mistake 5. Using wrong ITR form. If you have capital gains, ITR 1 is generally not allowed. Yes, the word generally, because there is an exception to this. See, individuals with LTCG up to rupees 1.25 lakhs from listed equity shares or equity mutual funds may be eligible to file ITR subject to conditions. But in most other cases, correct form for capital gains would be ITR 2. ITR 2 has Schedule CG for detailed capital gains reporting. If you use the wrong form, your return may be marked as defective or you may receive a notice. Mistake 6. Missing exemptions claims or incomplete details. One more mistake people make, and this one hits your pocket the most, is that they either forget to claim exemptions or they claim them incorrectly. Have you ever sold a property or asset and not claimed any tax benefit? This is very common. See, if you are eligible, the law already gives you ways to save a lot of tax. For example, Section 54, Section 54F, Section 54 EC, etc. But many people forget to claim the exemption at all, or they don't provide proper details in ITR, like investment amount, details of purchase or investment, and asset details, etc. And because of this, they either lose the benefit or the exemption gets rejected during processing. And result, you end up paying more tax than required. Why pay extra tax when the law itself gives you legal ways to save it, right? I have covered these biggest tax benefit like Section 54, etc. in my other videos on my channel. You can watch them if you want. Finally, one golden rule to remember is that different assets have different tax rules. Stocks, STCG and LTCG. Mutual funds depend on type. 25, crypto 30% flat tax, and gold depends on holding. So next time you book profit, don't assume all the money is yours. Government is your silent partner. Today's tax system is data driven. They already know your transactions. You just have to report them correctly. That's all for now. If you found this video helpful, please hit like and subscribe for more such content. Thanks a lot for your time, and let's take care of this beautiful world. I'll see you in the next video. And smile. Always smile.